We've seen one supply shock after another. The supply shocks, I think, are hurting purchasing power, as I said, in the U.S., could cause a recession. That will unwind the supply chain bottlenecks pretty quickly. We're looking at consumer sentiment down at levels we have not seen since 08-09. Think about that. Record-breaking employment, unbelievably good, and yet the consumer is feeling terrible. 08, and no one's talking about this. You know, everyone is saying, the economy's strong, the strong. When we saw the yield curve invert, and if you look at the 30-year to 2-year, it's a waterfall. It has come back a bit, steepened a little bit, partly because short rates have come down, which suggests to me that there are some people out there who might agree with us, who are saying, okay, the Fed, what's priced into the market right now is another 7 or 8 interest rate increases. That's priced in. And now they're saying we're going to be more aggressive than that. We'll go 50 basis points at a clip. We're going to get aggressive in terms of quantitative tightening, no longer quantitative easing. And so we're looking at consumer sentiment down at levels we have not seen since 08-09. Think about that. Record-breaking employment reports, record-breaking, unbelievably good, and yet the consumer is feeling terrible. 08, and no one's talking about this. You know, everyone is saying, the economy's strong, the strong. No one's talking about a consumer sentiment. This is the University of Michigan consumer sentiment, suggesting that the consumer, which is 2/3 of our economy, is not happy and is actually depressed because their wage gains, income gains, are not keeping up with inflation. Their real income is dropping. We've seen one supply shock after another. It went much further than I expected. I expected the supply chain bottlenecks after COVID to clear up in 6 months. It's been 2 years, all right? I didn't expect, we didn't expect Russia to invade Ukraine, which is the breadbasket of Europe. And it's the energy source for a lot of Europe. So those are two major shocks. I think Europe's in recession, and we can't think about the U.S. in isolation. Europe's probably in recession. China is, if we're looking at the micro numbers, China's very weak, very, very weak. And so everything's riding on the U.S. So the supply shocks, I think, are hurting purchasing power, as I said, in the U.S., could cause a recession. That will unwind the supply chain bottlenecks pretty quickly. And I think a lot of what we're seeing right now is a function of supply chain and supply shocks, very cyclical as well. And I think we'll see the other side of that. And then, as you say, we're seeing powerful deflationary forces associated with technology, artificial intelligence training costs alone, and this is going to involve every industry, are dropping, if you consider both hardware and software, 60% per year. That's just one example of the deflationary undercurrents in the global economy. And so I think longer term, we're going to see significant surprises on the low side of expectations when it comes to inflation. If you're a Bitcoin advocate, and we are, as you know, well, many people hold Bitcoin as an inflation hedge. I've just given you a deflationary story.
Right.
If we're right and deflation does happen, all of those companies who did not invest enough in innovation but leveraged up to deliver short-term profits, they manufactured earnings with lower share counts and they paid dividends, they're going to be in harm's way. They'll have to, in order to service their debt, they'll have to lower prices. So that's a part of the deflationary undertow we see out there. The Fed has to watch out because we see auto sales coming back down. And everyone says, that's supply chain. We see furniture stores, big disappointments. Restoration hardware is a good example. One retail industry after another is saying, whoa, something's happening here. But the headlines out there from a macro point of view are not picking up those micro signals, nor are they picking up the consumer sentiment surveys. So we're just looking at the facts and we're looking at all of the data. And the final piece I'll add is if you look at the inventory buildup that is taking place right now, partly because consumer demand is disappointing expectations, inventories can build up very quickly when the consumer goes on strike. So inventory to sales ratios might be low right now, but they can go up very quickly when the consumer says no mas.
Is Bitcoin a contrarian investment at this point, or are you feeling like it's becoming more mainstream?
Well, we were the first public asset manager to gain exposure to Bitcoin in 2015 when it was $250. I think today it's $44,000, and we think it's just begun. But I don't think most institutional investors are positioned the way they ultimately will be. A lot of retail has really led the charge here. They, like with our other funds, the retail investor, the individual investor, those people with one foot in the new world, they get what we do. They get Bitcoin. So I think institutions are coming along slowly.
Well, one of the undercurrents of this conversation too is the Fed and central banks.
Yes.
How does that affect Bitcoin and prices?
Well, again, many people think monetary policies around the world have been unhinged, especially since 08, 09, and they're seeing extreme increases in the monetary base, various monetary bases around the world. So Bitcoin is a hedge against inflation. Now, that will turn into inflation if the reserves on central bank balance sheets, which are the kindling for inflation, if they're lit. And that means if bank loans go crazy to the upside. We're seeing a share shift when it comes to loans into DeFi. So, there's a big, I think the banks have a big problem. They're losing talent to crypto, so they're having to raise wages to attract talent. And they're losing business to DeFi. Lending and saving, a lot of it is taking place in DeFi right now.
What are you thinking about ARK's underperformance, and how do you explain that to
Yes.
investors who might be worried about
Well,
price?
the investor who has been attracted to our strategies is a younger investor. I'll say it's across the spectrum, but the younger investors and the older investors who take us seriously about our 5-year investment time horizon, they're fine, because if you look at the past 5 years, we have outperformed NASDAQ, S&P, while I don't know what the number is, 75 to 80% of truly active managers have not. So we have that as a calling card, and we have a 5-year investment time horizon. We also give away our research. This is why we're investing in this space. And now we're playing more of a ground game, I would say. We're going to be publishing more of our models. And I think that our investor base is reading our research, seeing the merit that it has, and they also understand how these innovation platforms are going to disrupt the investments in their base portfolios, their core portfolios. So they're using us at least for a hedge against those value traps.